Welcome, Wall Street Alpaca here. In this video, we're going to talk about timing. We hear a lot about timing when it comes to investing and stock market trading. So we're going to begin by contrasting sort of some points of view that we hear from traders and from the long-term investors. And then I'm going to get into some of the details about what types of timing there is and what the different qualities that these different kinds of timing have for our use. We're here to make money and investing in the marketplace, in businesses particularly. So let's begin with the contrast. So there's the traders, and the traders, it's all about timing. You need to be there, and it's a mantra. Like, it's totally accepted that timing is a good, important part of their business as a trader. Now, on the other hand, we've got the long-term investors, business investors, and you can even hear, so I wanted to give you two kind of stereotype people that you could say are pretty solid in these businesses. So there's this guy, Dennis Dick, Triple D Trader on Twitter. He's a trader. He cares about timing and being there on the day, right at that moment. That's timing. And then the long-term investors, you can even do some, if you want to search at Google or something, you might have heard Warren Buffett and Charlie Munger, they're like, it's nothing to do with timing. Timing is totally irrelevant. And so that's quite a big difference. Both of these groups of people make money. And what's going on here that they have totally different opinions like that or express themselves that way. For me, I had to think about this. I dealt with this a lot, not just thinking. I was in there, guesswork, timing, what am I doing for a long time, and it did confuse me in many turns during my time in the market. So I hope that this video will clear some of this up for you, because I did finally settle the matter for myself. And so let's look at what the trader does for timing. Okay, the trader is often, like, it's a day trader. Maybe they trade on a week schedule or a monthly schedule. They might care about the immediate buy-sell imbalance in a stock, in a particular stock issue, or in the index. And they care about what went up across maybe a basket of 50 stocks. And they have a system where they try to live in this kind of imaginary world of the market. Well, it's a real thing, but it's kind of imaginary because they got their basket of 50 stocks that they put through their analysis every morning, and they say, oh, well, this one went up 2% yesterday, and this one went up 1%, this one went down 2%, so that's 3 different stocks, and they say, but I think they all should have gone up 1%. And maybe their trading strategy is to short the one that went up 2%, go long the one that went down 1%, and leave the one that just moved up 1% alone. And there might be a profitable trading strategy in something like that, because there are certain systematic market structural things like the index funds or the big, that follow the index, and so they're buying and selling all the different stocks, and there could be imbalances, just as I just explained, that first kind of trader with the buy-sell imbalances, or with an idea of a systematic imaginary regularity with the index. So that's a first, and I think that's the real way of trading with timing. Now there is also the next part of trading with timing where they just trade on news, and that's obviously all timing, right? If you're the first to get the news, it's a big piece of news, you got to get in there, right? Or get out of there, depending on the situation. So there's the traders with the systematic trading of market structure, and then there's the other kind of trader with the news. And then there's and we can kind of say that then there's the people who are just like, well, this is going to be really popular and I want to get in there before the other people. So that's also timing. So that covers the trading. Let's go to the long-term investor perspective. So how can Warren Buffett say that timing doesn't matter, right? And he talks about, well, all long-term investors end up talking like this. So Warren Buffett was just an example of a premier guy in the field. And what I mean to say is the long-term investor can say, I don't need the timing. I care about the numbers and the value of the business, how much money it's making. That's value investing. Or you're a growth investor with a long-term outlook. You care ultimately about that stock going up because the business is improving in value. So these are forms of long-term investing, the value and the growth avenues. It doesn't mean you can't have both, by the way, in a business. And so this is why the long-term investor doesn't worry about timing, because he just looks at the numbers and the timing comes to him. Okay, the trader goes out and looks for the timing opportunity, and the long-term investor sits back and waits for the obvious business opportunity, the numbers to match up for him on however he likes to evaluate his investment opportunities. So it is totally different. There's the first one, the trading is more frantic and getting in there to do work. And the second type of, and the long-term investor is kind of in there, but he lets the opportunities come to him. Or he goes and does legwork to look for the opportunities, but he doesn't go leaping on every chance. So now we're going to go to the second part of this video where we're going to go a little bit deeper into the timing thing, from my point of view especially. And I'm a value investor, long-term outlook, business investor is what I really am, as a business investor. And it's all about, it's a combination now for me, because I can look at the numbers. I've looked at so many different statements, financial statements, and so many different businesses that I start to build an experience where I can see that things that the company, that the corporate is doing, maybe they're doing buybacks that are going to come up. Maybe I learned how to read a financial statement. I can figure out that the free cash flow is going to go up, or the income is going to improve. And so there's certain elements of timing in that where, but it really is just the opportunity came to me. I just have to know how to recognize it. And this contrasts with other long-term investors who are just like, I just want to be in a wonderful business that's going to continue to be a wonderful profit-making business with a moat and all that for a long time. Their timing comes in simply because they found an opportunity and the price was right for them. And then they want to set it and forget it. In my case, I want to be able to move out of stocks maybe on a 1-year horizon sometimes. Even though I take the 3 to 5 year outlook, if I want to move in and out on stocks on a 1-year horizon, then I need to be able to interpret those parts where the business might start getting recognized. It has a catalyst, is what this is called. If you have so if I want to recognize the catalyst for the business, which my favorite one that I just mentioned is buybacks, or shares are outstanding are shrinking and free cash flow increases. Like that's a pretty standard catalyst for a business to start. It means the business is finding its legs again, and it started to express that in the marketplace by shrinking its shares outstanding while its cash increases. And that's kind of my digging into the timing idea as from the point of view of a business investor. It doesn't make me mad, like almost manic, like the trader is. You don't want to call it manic. They just wake up every day and do their job, right? But they have to act quickly. They have to get if they are doing open and close, buy-sell imbalances as a trader, they have to wake up every morning before the market opens, do all their analysis, and then put their orders in because they all execute at market open. And this other style from the long-term perspective, it doesn't. I want to get into a good catalyst opportunity before the catalyst takes place, and the market recognizes it and improves the share price. But But I can do all my research, after dark, and then wake up at 3 p.m. the next day and put my order in, and that sort of thing. So that's my explanation for how timing works and why it becomes a hot button topic, because it really affected me when I read Warren Buffett talk about timing is totally irrelevant, because I was like, I didn't understand it. But what it really boils down to is the timing isn't what matters when you're in a business investing mindset. What matters is that the opportunity is there, right there. The share price is at the right price compared to the earnings of the business. And then your timing happens automatically. And the trader has to go in and do timing, every single day. So that's the contrast, and I think that's why you hear those kinds of statements from long-term investors about how timing doesn't matter. And I hope that helped. Make sure you like and subscribe if you're here at the YouTube, because there's going to be more content coming. And Wall Street Alpaca signing off.